Good evening, everyone, and welcome to today's KMS webinar session. This is Ravi Mudaliar from Ekatva, and today's topic is decoding real estate under GST. It is my pleasure to introduce CA Jitendra Chopra, a distinguished chartered accountant and member of ICAI, who qualified here in the 2011 in first attempt. He is currently associated with Kandar Mehta and Shah as a senior manager and carries more than 15 years of extensive experience in indirect taxation with specialized expertise in GST and real estate sector. His areas of practice include GST advisory, litigation, refund matters, transaction structuring, and representation before CGST, DGGI, and state GST authorities. CA Jitendra Chopra is also widely recognized for his active contribution to GST knowledge sharing through LinkedIn and other professional platforms, where he is followed by more than 10,000 professionals across India. He regularly shares practical insights and addresses complex GST related queries. He has also contributed to publication Decoding GST on Real Estate and has played a key role in developing systematic operational process and SOP frameworks within the firm. Along with taxation expertise, he has keen interest in technology, AI driven solutions, and process innovation in the field of taxation and compliance. Let's warmly welcome CA Jitendra Chopra for today's seminar and look forward to his valuable insights and practical perspective on the subject. Over to you, CA Jitendra Chopra.
Thank you, Ravi bhai. Okay, first of all, thank you everyone who has joined this session today. As you all know, that real estate under GST is one of the most litigative and technically challenged areas under taxation. Even our almost 9 years of GST, practical dispute continues on in TDR, like what is development rights, in redevelopment structure, how free unit taxed, in plotting projects, what is basic development, valuation disputes like one-third deemed value controversy in Munjal Bhatt case, timing of taxation, ITC restriction like Safari retreat issue, and all such disclosure in GST return related to all these transactions. Many developers, landowners, consultants, and even department officers still interpret this provision differently. So today's objective is not merely to discuss theory. Our objective will be to decode the structure of taxation in real estate, to understand practical industry transaction, to understand where GST actually applies, and most importantly, where GST should not apply. So today's session is designed from a practical angle, and we will cover majorly 4 areas. Overview of GST on real estate, GST on TDR and JDA, GST on redevelopment project, and GST implication on plotting projects. So these are the broad topics which we will discuss today. The flow of the session is intentionally structured in this sequence. First, we will build the conceptual foundation. Once the basic become clear, then TDR and JDA become easier to understand. After that, redevelopment project become easier because redevelopment is actually an extension of TDR principles. And finally, plotting projects, which currently is one of the most controversial areas under GST. We will also discuss practical examples, valuation issues, litigation position, and recent judgment. So first, understand the legal framework. But interestingly, even ancient Indian text also discuss the concept of ideal taxation. So what will be the ideal taxation? In Mahabharata, taxation was compared with a bee collecting honey from a flower without damaging it, meaning taxation should be collected fairly without overburdening the taxpayers. And this becomes very relevant even today while examining the applicability on land, development rights, and redevelopment transaction. So let's start. So this slide is extremely important because the entire taxation of real estate revolves around the Schedule 2 and Schedule 3 entry. Whenever we analyze any real estate transaction, the first question should be, is it supply of service, supply of goods, works contract, lease, or sale of land? Now, if you see Schedule 2, Para 5B, specifically says construction intended for sale before completion certificate is treated as supply of service, meaning if any amount is received before due or completion certificate, GST become applicable. So it is very important practical point that even if only 1 rupee is received before the completion certificate, entire value become taxable. Now compare with this Schedule 3. It says sale of land is neither supply of goods nor supply of service. Sale of completed building after completion certificate is also the outside GST. So practically speaking, timing of receipt from the customer become critical. So one simple sentence which we can use practically, like before view is taxable, after view non-taxable. Now another important concept is works contract. So the works contract and the GST is restricted only to immovable property. This becomes very important in redevelopment projects and construction contracts. Also note, lease, rental, tenancy, licensing to occupy land, all are treated as supply of service. So many times developer and promoters wrongly assume that every land related transaction is outside GST. That is incorrect. Is outside GST, that is clarified under Circular 177. Rights arising from land may still become taxable. That distinction is the core litigation area under TDR. Now understand how GST law broadly cover these transactions. Under GST, like goods means movable property, service means anything other than goods. So therefore, GST has intentionally kept the definition of service extremely wide. That is why department mainly tries to tax development rights by saying that it is not a good, therefore it is service. However, every transaction may not automatically become supply of service because some transactions are specifically kept outside GST. Now, if we refer section 7 defining scope of supply, the definition has been kept very wide. It includes sale, transfer, barter, exchange, license, rental, lease. This wide drafting is the reason why disputes continue in real estate, because many transactions involve barter. Like example, in a JDA transaction, landowner give development rights to developer, and in return, developers give constructed area or flats to landowner. Even though no money may be involved, GST department treats this exchange as consideration. Therefore, such barter transaction may become taxable under GST. This is the basic concept behind GST applicability on JDA structure. Now, this is one of the most important foundation slides for understanding GST on real estate. Because before discussing rates, TDR or redevelopment, first we need to identify whether transaction itself is taxable as goods, service, or completely outside GST. And practically, most real estate transactions finally fall either under construction service under Schedule 2 or sale of land building under Schedule 3. So if transaction is in the nature of under construction property, GST come into picture. But where it is pure sale of land or completed property after view, transaction normally goes outside GST. So in real estate, taxability does not depend only on agreement. It's largely depend on nature of transaction, stage of construction, and timing of consideration or collection from customer. So this distinction become very important throughout this session, especially while discussing JDA, redevelopment, and property plotting projects. Now, this become a very important concept because entire litigation related to TDR and development rights actually start from the concept of land and immovable property. If you see various laws like RERA, Transfer of Property Act, Registration Act, almost all laws recognize benefits arising from land as immovable property. Now, this is the main constitutional argument taken before high courts, and this becomes important in GST because taxpayer generally argues that development rights or FSI are nothing but benefit arising out of land, whereas department try to treat such things as taxable services. This distinction is used actually the base of many ongoing disputes under GST. So many recent High Court matters are still pending. So law in this area is still developing. Now let us simplify the entire concept. So pure sale of land, no GST. Sale of developed land with basic development, still no GST as per Circular 177. Sale of completed building after view, no GST. Sale before view, then GST will be applicable. Works contract services, GST will be applicable. Now understand this by example. Like in this slide for unit A, entire amount received after completion certificate, GST will not be applicable. Part payment before completion certificate, entire 50 lakh become taxable. For unit C, entire payment received before completion certificate fully taxable. Many clients make one common mistake, like they believe only advance received before view is taxable. That is incorrect. if any amount received before due, the whole transaction become taxable. So now from April 2019, the classification of projects become very important. The most critical distinction is RREP versus REP. So what is RREP? Residential real estate projects where commercial carpet area does not exceed 15%. So why is this distinction important? Because GST rate change, ITC eligibility changes, TDR implication also changes. So one practical mistakes seen during audits are like developers calculate 15% based on value. That is incorrect. Law refer to carpet area. Always verify carpet area for distinction of REP and RREP. In 34th GST Council meeting, which brought major changes for the real estate sector from April 2000 onwards. One of the most important change was the classification of projects into REP and RREP, along with the reduction in GST rates for residential projects and specifically the affordable housing projects. Now, these are the effective rates after April 2019. So affordable housing effective 1%, non-affordable residential units effective 5%, and commercial the effective rate is 12%. Now, very important practical clarification is this, that these are the effective rates after deemed one-third reduction of lands. Legally actual rates are 1.5%, 7.5%, and 18%, which are applied on two-third value of collection. This becomes the important for GST returns. Many developers disclose wrong taxable value in GHR 1 and 3B. So for this, we will discuss it in next slides. Like for the ongoing projects, there was an option in April 2019 that developer could continue old rate with ITC or shift to new concessional rates without ITC. So this was one of the biggest transition exercise in real estate under GST in April 2019. Even today, department audits officer asked whether option exercised properly, whether transition ITC reversed correctly, or whether project-wise segregation maintained. So documentation becomes extremely important. So this is like a highly compliant slide. Please remember, although the effective rate may be 1, 5 or 12, but the disclosure should happen at the full rate 1.5, 7.5 and 18 on 2/3. Now, why this is important? Because if disclosure is made incorrectly, system reconciliation mismatches happens, department issue notices and annual returns mismatches arise. Also, another important issue, 1/3 land deduction should ideally not to be shown as exempt supply. In practical view, showing it as exempt supply unnecessarily inflate the exempt turnover and effect Rule 42 reversals. Now, this slide is related to the disclosure of transactions of real estate in GST returns. Practically, advances are received first, monthly or milestone basis, and accordingly tax liability and disclosure requirement arise. But where advances are received before due or completion certificate, same needs to be disclosed properly. Later, once invoice or sale deed is issued, invoice disclosure and advance adjustment also need to be done. Now we will move to the most litigative area under real estate, TDR and JDA. This is the area where the maximum notices, writ petitions and constitutional challenges are currently happening.
सर्वात जोरदार से like when पहला बोलूं गीत में गया शिवा I'm like generally
Jitendra Chopra, you have to unmute yourself.
Okay. Now we are discussing TDR and its taxability. So before discussing GST implication on TDR, let's first understand some very important practical concept used in real estate industry. Many times these terms are used interchangeably, but technically all three are different. Like first is TDRC. TDRC is transferable development rights certificates. This is generally certificate issued by authority in cases where land is surrendered for public purposes or redevelopment activities. For example, in slum redevelopment projects, authority may issue TDR certificate to developer in consideration of redevelopment undertaken. But now next is TDR, like transfer of development rights, refer to the transfer of development rights by a landowner to a developer or a promoter for the purpose of development of land and building. And the last is FSI. FSI basically means permissible construction area allowed on a particular land parcel. So this can be a basic base FSI, premium FSI, and maximum permissible FSI. Now, why this understanding important? Because tax treatment may differ, especially after recent litigation. Many high courts arguments are based on whether these rights are actually benefit arising out of land. So understanding legal character become essential for TDRC, TDR, and FSI. This comparative table, like to understand these terms, we have made this comparative table. So TDRC issued by authority may be treated differently. Additional FSI granted by authority may also have been different treatment. But private transfer of development rights by a landowner to a promoter is where GST department aggressively taxes. The department stand is this is supply of service under the heading 9972. But the taxpayer argues that this is the transfer of immovable property. Now, this is the core dispute. So initially, like GST law itself was unclear about what is TDR or development rights, but notification 4/2018 was the first which referred to the development rights under GST. So this is very interesting. This notification only prescribed the time of supply for TDR. It does not itself create taxability, and it only deals with area sharing agreement. So this agreement is heavily used before high courts. So before April 2019, for transfer of TDR to developer under area sharing agreement, landowner are liable under forward charge and developers are liable for the construction services provided to landowner. After April 2000, entire mechanism changed. Like in 34 GST Council meeting was one of the most significant turning points for the real estate sector under GST, as we earlier discussed. From April 2000 onwards, major changes were introduced, including reduction of GST returns, GST rates, introduction of RREP and REP concepts, restriction of ITC, and most importantly, major change in taxation mechanism for the development rights, including valuation and time of supply of provision for TDRs. So before April 2019, landowner paid GST under forward charge, but after April 2019, liability is shifted to the promoter under RCM. This was a major policy shift because liability to pay GST on TDR shifted from landowner to promoter. Further, after April 2019, ITC restrictions were introduced for residential projects. Therefore, GST applicable. So therefore, GST paid on TDR in residential projects generally becomes a cash cost for the promoter, which directly impact their overall profitability. So now understand the number of transactions under JDA, joint development agreements. So one JDA actually contains multiple supplies, like landowner to promoter, supply of TDR, promoter to landowner, supply of construction services, promoter to customer, the sale of original under construction flats, and landowner to customers, the resale of under construction flats allotted by promoter to landowner. So many people analyze JDA as a single transactions. However, under GST, every leg of transaction need to be examined separately because each transaction may have separate taxability, valuation, and time of supply. So this is the classical area sharing. So like landowner gives development rights to landowner gives development right to landowner gives development rights to developer. Developers gives constructed area to landowner, and then developer sale balance inventory. Now in this structure, there are two important valuation problem issues, like how to value TDR, how to value the construction services. So both are linked to the value of a similar apartment sold nearest to the agreement TDR agreement date. Now in revenue sharing, landowner give development rights to developer but receive revenue share instead of flats. This creates separate controversy, especially on whether monetary consideration changes character of transaction, whether TDR remain taxable, or what is timing of taxation. Also, notification 4/2018 not covered this model of JDA or specifically TDR. Several Bombay High Court matters are related specifically to revenue sharing, where interim relief was granted to taxpayer. Now, let us examine overall taxability of TDR under JDA. Who will pay GST on TDR? Promoter under RCM as per entry 5B of reverse charge notification. Rate will be 18%. But one of the most important and beneficial provisions related to taxation of TDR is exemption available for residential units for booked units before due. Practically, GST on TDR is not payable on the portion of residential area which is booked before due. Therefore, in most residential projects, GST on TDR remains only on unsold units as on completion certificate. This provision has specifically significantly reduced like GST impact on residential real estate sector after April 2019. However, no such exemption is available for commercial units, and accordingly, GST on TDR continues to apply on commercial portion. Also, the time of supply for GST on TDR is deferred till BO for residential projects. Now, separate from TDR, developer also provide construction services to landowner. So this is taxable. Now, many developer ask like we have not received money for such construction services or area transfer to landowner. Is it still taxable? Answer is yes, because barter is also consideration. For valuation of construction services provided to landowner, para 2F notification 11/2017 become important. As per this provision, the value of construction services shall be deemed to equal to value of similar apartment sold to independent buyer nearest to the date of transfer of development rights, less 1/3 value towards lands. Meaning, when you are taking a value of TDR, same will be the value of development right, same with the value of construction services, less 1/3 value. Now, this slide is comparatively straightforward. This is related to the under constructed unit sold by landowner and promoter. So, promoter selling before due is it taxable? Landowner selling allotted inventory before due, which is also taxable. But now, one critical point. Landowner may be eligible for ITC when he sold units allocated by the developer as per notification 3/2019. But promoter in residential project generally does not. This restriction is often ignored by many consultants. This table summarizes the taxability of entire area sharing structure for both TDR and construction services. So important concepts are promoter liable under RCM, exemption for booked residential units, valuation will be linked to the similar apartments, GST is applicable on unbooked units for residential projects, and ITC are restricted. Now, this slide explains GST on revenue sharing under JDA. One very important point in JDA is related to time of supply. In both area sharing and revenue sharing model, GST liability on TDR as well as construction services generally deferred till BU or completion certificate. Therefore, promoter is normally required to discharge GST at the time of completion certificate and not the time of entering into JDA. However, there is one important exception. In case of commercial project under revenue sharing model, GST on TDR become payable immediately at the time of development agreement or payment, whichever is earlier. Now, these judgments are extremely important. Different high courts are currently taking different approaches. Some courts have upheld taxability, some have granted interim relief, some matters involve legal challenge itself. But one of the most critical judgment on TDR is the Bombay High Court case in the case of Srinivasan Realcon Private Limited. In this case, the court examined whether the transfer of development rights by a landowner to promoter is actually covered under 5B, entry 5B of RCM notification. The petitioner argued that the GST liability under RCM cannot be imposed because the notification itself does not cover such transaction. The Bombay High Court accepted his argument and quashed the departmental order. This judgment is very significant because it directly questions applicability of GST on TDR under reverse charge mechanism. Even yesterday, in case of Ishan Putra Sweets Homes Private Limited, Madhya Pradesh High Court has granted interim relief against GST demand related to TDR, which again shows that litigation on taxability of development right is still continued before various high courts. So Practical advice for the industry is maintain strong documentation, especially nature of rights transfer, development agreement clauses, valuation working, booking reports, due dates. Because litigation relating to TDR and GDA is still continuing, and documentation will become very important during assessment and future disputes. Now we will discuss GST implication of redevelopment projects. Like in a typical society redevelopment project, society or the existing member allow the developer to redevelop the existing property. In return, the developer generally provides new constructed flats to the existing member and also get rights to construct and sell additional area or flat in this project. So practically redevelopment is an exchange arrangement. Society gives redevelopment rights and developer gives construction services in return. Further, developers also sell additional units to new buyers for commercial consideration. Therefore, multiple transactions arise in a single redevelopment project, and each transaction has a separate GST implication. So in a redevelopment project, three major transactions happens. First, society give redevelopment rights to developer. Second, development give free flats or construction services to existing members. Third, the developer sells additional flats to new buyer. So now this is the taxability of first transaction, development rights transferred by society to developer. In this, developer will pay GST under RCM on TDR. For residential units, exemption is available to the extent of book units. For commercial units, no exemption. Valuation will be based on similar apartments. Time of supply for paying tax on development rights will be at the time of due or completion certificate date. This is the same as we discussed earlier related to TDR. Now, this is very important concept in redevelopment project. Many times people say that developer is giving free flats to existing member, but under GST, these flats are not actually treated as free because the society or existing members are giving development rights to developer, and in return, developer is providing newly constructed flats. So GST department treat this transaction as construction services provided by developer in exchange for development rights. Therefore, GST become applicable even though no money is received from existing members. For valuation also, value of similar flats sold in the project is generally considered after 1/3 land deduction. And this is one of the most important practical interpretation under GST, where many consultant developer get confused because developer receives no money consideration but still has to discharge GST on free units given to existing members. And the last transaction in redevelopment project is sale of additional units to new customers. So this part is relatively straightforward. Like before view, is it taxable? After view, it is exempt. Residential 1 or 5% and commercial like 12% effective. But commercial projects may also require Rule 42 reversal for post view inventory. Now, this slide explains practical GST implication on free units given to old member in redevelopment projects. Like here are 12 old units, new 9 new units. Now broadly, two valuation approaches were being followed in industry. In option 1, the value of free units given to the old member is considered equal to the value of new flat sold to customer, and like as prescribed in para 2A of rate notification 11/2019. So here value per unit is taken at 50 lakh rupees. Accordingly, GST liability on old units come to around 30 lakh by treated as, so this will be treated as residential construction services taxable at concessional rate. Therefore, ITC will not be available, and entire GST of 30 lakh become cash outflow for developer on old units. Now, in option 2, some developers take valuation based on construction cost plus reasonable margin as per Rule 30 of CGST rules. So here value per unit is taken as 30 lakh instead of 50 lakh. However, transaction is treated as works contract services taxable at 18%, but benefit of ITC become available. So GST amount appears higher initially, but after ITC adjustment, actual cash flow reduced substantially. If you see here, the net cash payment reduced from 50 lakh, 52 lakh in option 1 to around 42 lakh in option 2. Therefore, many developers practically evaluate both structure from overall cash flow and ITC perspective. So these are the provision related to redevelopment projects. Like first is provision free units, like the clarification related to free units provided by land the promoter to society members. Second, valuation of construction services for free units to existing members in redevelopment society. And the last, valuation of development rights transferred by society to developer. Now, here come one of the most litigation areas currently, plotting projects. This is where conflicting advance ruling, circulars, and department views exist. So RERA specifically includes development of land into plots as real estate project, but GST Schedule 3 exclude sale of land. Now this creates controversy. So question arises, at what point does land development become taxable service? So this is the core issue in plotting projects. Now this slides presents conflicting rulings in case of the plotting projects. Earlier, Gujarat WR took aggressive view of 18% GST on sale of plots. Later, circular provided relief. But subsequently, Karnataka ruling also gave relief in developed plot cases. But please note that advance rulings are highly fact specific and only applies to applicant in his state. Project documentation matter heavily to know exact facts for plotting scheme. Now, the main circular 177, which gave major relief to developer for plotting projects, where CBIC clarified that representation has been received requesting for clarification regarding the applicability of GST on sale of land after leveling, laydown or drainage lines. So they clarified that sale of plot remain sale of land even after some basic development. They have used word some development such as leveling, drainage, water lines, electricity lines. So these are the very important. Now practical controversy remains, like what is basic or some developments and what becomes taxable amenities. This line is still blurred. So now what practical issues exist even after clarification by circular 177? When extra services supplied along with sale of plot, how GST will be charged? Because amenities may not be considered as basic development. In this case, department argues, if substantial amenities provided, transaction become composite taxable supply. But industry argues that dominant intention remains the sale of land. So this debate still continues. More important issue in plotting projects are whether plotting projects under a joint development agreement are exempt or taxable, and whether development rights transfer in such case falls outside GST, because exemption for GST on TDR for booked units is only for residential projects, not for plotting project and commercial projects. However, when transfer of land is combined with the construction services, there could be GST implication that require attention, particularly in clubhouse projects, plotted villa projects, gated community projects. So this slide is very important practically. Like it explains different models under plotting projects. Like first is simple developed plot with basic development. So this is covered under circular 177, which explained that it is outside the ambit of GST Act. But once additional amenities like extra development, landscaping, clubhouse, luxurious villa then GST exposure increases. Therefore, structure and drafting becomes very important. Now, if we summarize the transaction under plotting projects, sale of land with basic infrastructure not taxable, and also ITC will not be allowed. But but if construction activities are provided with extra construction activities are provided with sale of plot, then it will be taxable only for so only construction activities are taxable at the rate of 18%. So also for the clubhouse and amenities, same 18% will be applicable. But in this case, the main issue is how ITC will be apportionate or attributable to sale of land, other construction work, development charges, villa on land. So for the common ITC, amount attributable to land consideration will have to be reversed in that proportion, considering the sale of land as exemption supply. So one of the most advanced ruling is on the plotting project is Godrej properties ruling. This Godrej property ruling is very important because it separates land, basic development, and amenities. According to this ruling, basic development may remain non-taxable, amenities and facilities may become taxable. So separate bifurcation and agreement drafting become critical. Like in this judgment, they have made questions like that whether applicant is liable to charge GST if booking of plot, receipt of consideration, and agreement for sale is entered, as well as sale deed is executed after the release certificate. Like they have covered both concept in this advanced ruling, that the consideration, even if it is received before or after, then we have to separate all such components differently, like land with basic development and amenities. So according to this ruling, in both cases, sale of plot will not liable to GST. Basic infrastructure development charges also not liable to GST as per Circular 177. But other common amenities and facilities charges, both in before and after, GST will be applicable. And the third question is main, like what is the applicability of GST if sale price is consolidated price in agreement for sale towards land cost, basic infra charges, and other commodities. So they have answered that GST is applicable on charges proportionate to common amenities and facilities. So we have to bifurcate the whole sale deed into the sale of land value and other charges. So now Ravi bhai, we will take question and answer.
Thanks, Jitendra Chopra ji. The forum is open for question. Please feel free to ask questions, if any. I think no questions. Thank you so much, CH Jitendra Chopra, for the insightful session, and thanks to the wonderful audience for active participation. Thank you.
Okay, thank you, Ravi bhai. I hope this webinar helped simplify some of the most complicated aspects of GST on real estate. The real challenge in this sector is not to understand the law. The real challenge is identify the correct transactions, identify correct timing, correct valuation, and maintaining proper documents, especially in TDR redevelopment plotting projects. Each structure should be independently evaluated. So thank you everyone for joining. Special thanks to KMS and the organizing team Ravi bhai for arranging this webinar. If there are any further queries, please contact us. Thank you.
We have one question on the chat.
Yeah.
What is the GST applicability on TDR provided by GHB to promote for development of low cost housing society?
So we have covered this. So this will be the I think this will be the TDRC, the Transferable Development Right Certificate, provided by the public authority to the developer. So this will become neither supply of goods nor supply of service as notified under 243W or 243G.
Hope that answers your questions, Mr. Nakul Thakur. Any other question from anybody? Thanks, Mr. Nakul, for the confirmation. I think there is no questions. Thank you so much, everyone.
Okay, thank you, Ravi bhai and all.
Thank you.